You know, Joe, given yesterday was a very important day for the company, not to mention, of course, it seems to be very well received by the analysts in attendance and the investors who were there, given at least the stock is going to be up meaningfully this morning with a lot of positive comments out there. Listen, they gave us the targets that we had said that they might. They came with full transparency. It was hours of content coming at you. And then Christine McCarthy, the CFO, stood up there and basically laid out the numbers in terms of 60 to 90 million subs that they expect for Disney Plus by fiscal year 2024 end. The original content spend of at least $1 billion early and then going up to $2 billion over the next few years. Licensed content expenses. This is an important component of that. It's not just what they're going to be doing intercompany in terms of paying license fees to themselves, in a sense, but it's the license fees that they're giving up in terms of third-party sales. Those are very significant. And some people say, listen, you got a great business there. You're talking, what, $2.5 billion in incremental income as much as this year, going up to even more than that in years to come, given the voracious appetite of the likes of Netflix and other platforms for your content. But you're not going to do that anymore. You're keeping it all to put on the platform, and that is a big give up. So I did ask Mr. Iger, why is it worth going that route as opposed to the very profitable route you've been following?
I'm an optimist. I'm a realist, but I'm an optimist. And I've been at the company for 45 years. I've been president or COO since 2000. And I have a strong understanding of, or a deep understanding and appreciation of Disney and its brand and its relationship to consumers. And so I'm pretty optimistic about the ability for this thing to work, particularly when we make it accessible because of the content we're putting on, because of the user interface, and because of the price. So I believe this is going to be successful. If in 5 years' time it proves, I prove to be wrong or we prove to be wrong, we're still making great content that's going to be in great demand globally.
Because he's talking about the idea that, well, listen, and because I brought this up, what if it doesn't work? What if all the content, you're a prisoner now of your service. You're not licensing your content to anybody else. You're making it all for the service. What if it doesn't work? You heard his answer at the end there, guys. But for now, $6.99 at the price point they're talking about. The free cash flow losses, the losses to free cash flow are going to be very significant. But investors seem very willing to look past that. Perhaps some had anticipated losses would be a bit more. Some perhaps had anticipated less. But I can tell you they are happy about the projections of 60 to 90 million there, of 40 to 60 million for Hulu, of which they control 60% and therefore control the company, although have to deal with their partners both at NBC Universal, our parent company, and right now at AT&T. And then also ESPN Plus, which is not seen as a replacement for ESPN, but they do expect to have as much as 8 to 10 million in subs over the next few years, getting profitable a bit earlier than these other platforms. They don't expect profitability on Disney Plus until 2024.